Economic growth rate slows to 2% on a sharp slowdown in consumer spending. By Jeff Cox, CNBC. The U.S. economy grew at a 2% rate in the third quarter, its slowest gain of the pandemic-era recovery, as supply chain issues and a marked deceleration in consumer spending stunted the expansion, the Commerce Department reported Thursday. Gross domestic product, a sum of all the goods and services produced, grew at a 2.0% annualized pace in the third quarter, according to the department's first estimate released Thursday. Economists surveyed by Dow Jones had been looking for a 2.8% reading. That marked the slowest GDP gain since the 31.2% plunge in the second quarter of 2020, which encompassed the period during which COVID-19 morphed into a global pandemic that resulted in a severe economic shutdown that sent tens of millions to the unemployment lines and put a chokehold on activity. Across the country, declines in residential fixed investment and federal government spending helped hold back gains, as did a surge in the U.S. trade deficit, which widened to a near record $73.3 billion in August. The drops mostly offset increases in private inventory investment, a meager gain in personal consumption, state and local government spending and non-residential fixed investment. Consumer spending, which makes up 69% of the $23.2 trillion U.S. economy, increased at just a 1.6% pace for the most recent period, after rising 12% in the second quarter. Spending for goods tumbled 9.2%, spurred by a 26.2% plunge in expenditures on longer-last goods like appliances and autos, while services spending increased 7.9%, a reduction from the 11.5% pace in Q2. The downshift came amid a 0.7% decline in disposable personal income, which fell 25.7% in Q2 amid the end of government stimulus payments. The personal saving rate declined 8.9% from 10.5%. Federal government spending fell by 4.7%, which the Commerce Department said was due to a halt in services and processing for the Paycheck Protection Program, a pandemic-era initiative aimed at providing bridge funding to businesses impacted by the shutdown. Overall, this is a big disappointment given that the consensus expectation at the start of the quarter in July was for a 7.0% gain, and even our own bearish 3.5% forecast proved to be too optimistic, wrote Paul Ashworth, chief U.S. economist at Capital Economics. We expect something of a rebound in the final quarter of this year, if only because motor vehicles won't be such a drag, and any negative impact from Delta should be reversed. In a separate economic report, jobless claims totaled 281,000 for the week ended October 23, another pandemic-era low and better than the 289,000 estimate. The total marked a decrease from the previous week's 291,000. Continuing claims fell by 237,000 to 2.24 million, and those receiving benefits under all programs dropped by 448,386 to 2.83 million. Stock market futures remained higher after the report, while government bond yields also climbed. The July to September period saw a major clogging of the nation's supply chain, which in turn dampened a recovery that began in April 2020, following the shortest but steepest recession in U.S. history. Shortages in labor and soaring demand for goods over services contributed to the bottleneck, which is not expected to ease until after the holiday season. Despite the Q3 weakness, economists largely expect the U.S. to bounce back in the fourth quarter and continue growth into 2022. Another significant factor for the Q3 number was the summertime rise of the COVID Delta variant, a situation that has reversed itself in much of the country. Consumer activity, particularly in the vital services part of the economy, appears to have picked up and could fuel a late-year growth burst. As Delta cases continue to subside, there may be more growth in the fourth quarter as consumers will be more willing to spend on services involving in-person interactions, said Doug Cabot, senior economist at the Credit Union National Association. The supply chain challenges, however, will likely continue until next year, making it difficult to satisfy increased consumer demand. Companies during the current earnings season have noted the issues with supply chains, but many say customers are willing to pay higher prices. That in turn has helped fuel inflation, which is running close to its 30-year high, and also is expected by most economists and Federal Reserve policymakers to cool next year. Thursday's data indicated that at least the pace of the inflation rise had taken a step back. Core personal consumption expenditures, which exclude food and energy, and are the preferred gauge by which the Fed measures inflation, rose 4.5%, a deceleration from the second quarter's 6.1% increase, but still well above the pre-COVID pace. The headline PCE price index increased 5.3% in Q3, down from 6.5% in the previous period. Biden races to Congress to save agenda ahead of Europe trip. By Trevor Hunnicutt, Reuters. U.S. President Joe Biden will push for his party and the nation to coalesce around a trimmed-down domestic spending plan on Thursday, according to people familiar with the matter. Biden is expected to sketch the outlines of a deal that he thinks can unite the Democratic Party, which narrowly controls the legislature, but has struggled to agree to a deal. He plans to travel to Capitol Hill for a 9 a.m., 1300 hours GMT, meeting with House Democrats, before delivering a speech on the status of his back-and-forth negotiations over a bill he hopes will invest more than $1.5 trillion in new social safety net programs over the coming decade. Then, he plans to deliver public remarks at 11:30 a.m., 15:30 GMT, at the White House, before he departs for Europe to meet with world leaders. U.S. Representative Hakeem Jeffries, who chairs the House of Representatives Democratic Conference, said he understood Biden would discuss a planned framework that appeared to have support from all Democratic U.S. senators, clearing a major hurdle. The plan would encompass a historic investment in job creation, children and families, protecting the planet, and expanding access to healthcare, he told MSNBC. Still, it remains unclear whether Biden has the votes needed to pass either the social spending into law or a companion bipartisan $1 trillion infrastructure bill. Liberals have vowed to block the latter measure until they see a social spending bill that invests sufficiently in healthcare, education and climate change mitigation, among other priorities. Some Republicans support the infrastructure measure, but most lawmakers in that party oppose both bills. Climate Summit. Even if a framework is adopted in coming days, as Democrats hope, Biden will likely arrive to a meeting of G20 leaders in Rome, and then the UN Climate Change Conference in Glasgow, Scotland, without final legislation in hand, even as the United States seeks to ask other countries to adopt similar initiatives. Democrats have a slight majority in the U.S. House of Representatives, and only narrowly control the 50-50 split Senate, with U.S. Vice President Kamala Harris holding the tie-breaking vote, meaning legislation must win support across a wide swath of progressives and more moderate members of the party. The White House on Wednesday said Biden had flexibility for his departure, and has said he can continue to work with lawmakers on his agenda amid his trip, including from moderate Democratic Senators Joe Manchin and Kyrsten Sinema, who opposed Biden's initial plans. Details matter. On climate, their life plus death. So to do my job, I need more than an IOU. Not too much to ask, U.S. Representative Alexandria Ocasio-Cortez said in a post on Twitter late Wednesday. House Majority Leader Steny Hoyer told CNN plans for paid family leave have been dropped, and that $555 billion would be included for clean energy. Jeffries gave no details on the framework, but said he would support the deal, given the urgent need for climate action, even if the paid leave provision is dropped. If it turns out that the votes don't exist for it in the Senate, we will live to fight another day, he said. Federal Reserve could soon trigger another investor panic in Asia, 2013 style. By William Pesek. Forbes. Suffice to say, Jerome Powell's Federal Reserve doesn't seem to scare Asia the way Ben Bernanke's did back in 2013. 8 years ago, markets had a giant taper tantrum. Investors went mental over hints then Governor Bernanke's Fed might reduce asset purchases. Not an interest rate hike, just a possible throttling back on Lehman-era quantitative easing policies. Bernanke didn't do it, of course. Perhaps spooked by the specter of crashing the global financial system, the Fed demurred. It wasn't until 2 years later that his successor Janet Yellen was normalizing rates. Yet now, as inflation pressures intensify and economists like Lawrence Summers warn of overheating, Fed tapering is back on the table. Perhaps soon, should upcoming employment data flag wage spikes. Or supply chain woes push US consumer prices above the current 5% range. And yet Asia is acting like there's little to fear. Fast forward 8 years, and there have been good reasons to think that Asia could happily avoid a rerun of the taper tantrum, says analyst Vincent Sui at Gavical Research. Not least of which was using the 2013 chaos as an excuse to reinforce financial systems. The problem for Asia, though, is that it's more vulnerable now to a monetary bout faced by the Fed. Here are 3 reasons why emerging Asia, ex-China, is ever more exposed to an investor panic today than in 2013. 1. External positions are now in a markedly different place. Many Asian nations tend to be importers of resources, and at a moment when commodity prices are surging. This has averaged trade surpluses at their narrowest levels since 2012, just before the Fed stopped the music keynotes. It means greater vulnerability if liquidity suddenly goes scarce. 2. The share of onshore capital owned by foreign investors is now higher. At the moment, central banks in the region are on average holding about 1/3 more foreign exchange reserves than 8 years ago. That's a good thing. Yet, Sui says, the share of holdings by foreigners has generally risen by an even larger amount, lowering the coverage ratio if markets stumble. If investors rush for the exits, in other words, governments have fewer tools right now to maintain calm and more worries as capital zooms elsewhere. 3. Sovereign fundamentals among governments are weak after 20 months of pandemic rescue efforts. COVID-19 is causing public debt to soar, Sui says. Having to service big debt piles will constrain monetary policy responses to external volatility, as policymakers will have to weigh the impact of higher debt servicing costs if contemplating big interest rate hikes to stem capital outflow. In addition, global conditions are turning against Asia. Though this region tried to wean economies off exports, shipping goods overseas remains the top growth engine. The US recovery is disappointing many. The difficulty President Joe Biden is having getting more Americans vaccinated is undermining the biggest economy. Neither Europe nor Japan is recovering convincingly. China, meantime, is seeing growth wane at a moment when property sector defaults are grabbing global headwinds. President Xi Jinping's economy is facing a domestic power shortage, while rising global commodities prices are fanning mainland inflation. There's also the specter of increasing trade tensions with Washington. This week, Xi's government slammed U.S. Secretary of State Antony Blinken's call for an increased role for Taiwan in UN organizations. China claims it violates the One China framework. The state-run Global Times published an editorial assailing Biden's White House for opening a new offensive on Taiwan relations. It argued China won't step back an inch a year ahead of when Xi hopes to clinch an unprecedented third term as Communist Party leader. Mainland shares are dropping after the Federal Communications Commission banned China Telecom's U.S. unit, citing national security concerns. Washington's more assertive stance collides with Xi's chilling tech crackdown as home, a policy that has foreign investors questioning Beijing's capitalist street cred. It's been promising in recent weeks to hear both Washington and Beijing are striking a measured tone on key issues as they look to preserve a recent and fragile effort to stabilize the relationship and look ahead to a virtual summit between Biden and President Xi Jinping before the end of the year, says analyst Michael Herson at Eurasia Group. Still unclear, though, is whether the sharper rhetoric of recent days pushed the global economy toward an even bigger trade war. It's unclear, too, when the Powell Fed might upend markets with a dose of monetary austerity. The risk is that Fed complacency sees markets tighten for Powell, and the globe's most powerful monetary authority playing catch-up. That could further damage the Fed credibility that maintains the dollar's reserve currency role. Even less clear is how investors should play the weeks ahead. Looking back to the 2013 to 2014 period, the currencies that performed best were the Chinese yuan, the Korean won, and the Taiwanese and Singaporean dollars. The Indian rupee and most Southeast Asia currencies did less well. Navicals Tsu says a similar picture exists today, with Northeast Asian tech exporters benefiting from a tight market for microchips. Southeast Asian economies, in contrast, face weak growth due to their lower vaccination rates, which will mean continued production outages, constrained consumption spending, and limited tourist arrivals. The bigger threat, though, stems from the policy exhaustion of the COVID year. Asian officials have less latitude and fewer weapons to deploy if the Fed pivots toward restraint. It could make 2022 a year of seatbelt buckling, not one of markets letting down their guard.